Thanks a lot, Esili, for joining us. And like I mentioned, another good day for the markets.
Yes, I think equities were up slightly higher today. The banks obviously at the top of that, but we think that that obviously could be short-lived. But regardless, anyways, we think the market has done relatively well given the circumstances. Fixed income yields are still quite high, and there's still obviously a lot of shadow cast with respect to concerns of a global economic growth and the exchange rate of the naira to the dollar.
Indeed, some risks ahead of us there. But your thoughts on particularly the consumer good companies, because I know that those are those that you follow those quite closely. And we've seen a few results coming out of Honeywell flour mills and flour mills in particular. We've seen some price reaction to those numbers. But overall, your thoughts on what we've seen so far?
It's been quite mixed. For starters, flour mills of Nigeria published pretty poor numbers. For the financial year 12, their EPS was down by 27%. That, I think, to a large degree dented management's credibility, especially given how strong their guidance on earnings for that particular period was. Even more surprising was the fact that there were strong tailwinds. You had quite an increase in bread flour price during the period. The price of wheat was significantly lower, almost 20% lower during the period. And then you had a pretty strong volume growth in the cement business, which was actually scheduled to terminate in the first half of 2012. So, it wasn't what investors would expect, and I think that management certainly has a lot of explaining to do.
But is that something that will trigger a re-rating in your books? Because flour mills, of course, is one of the high-cap companies in Nigeria, something that has been generating some interest over the last few years.
I mean, we've always said it's a long-term play, and a major catalyst to get in there is, the ongoing, restructuring the business. Flour mills at the moment is trying to be, a consumer branded good company, and they're currently investing a lot of money in that. And I think that a lot of that will produce, a lot of fruit over the short to medium term, and that's why we aren't changing our rating at the moment. We still have some confidence in the company. I think we could give management some, another chance to prove themselves. With respect to Honeywell, which also published numbers, those were particularly strong, given that the previous year had was a very high base. EPS was up by about 8%. Key growth drivers were strong volumes, particularly in the fourth quarter, and an abnormally low interest charge. So I think Honeywell obviously did well that period, but we're still quite skeptical or cautious going into the medium term. I think that there are a number of factors inclusive of its lack of scalability at the moment, and also significantly higher interest charges that could dampen medium-term earnings.
Right, we've seen a lot of, we're still expecting quite a number of results from the manufacturing companies, but what can you read from these two numbers? I think these are perhaps the most significant ones we've seen over the last few sessions.
That's actually interesting. I think these numbers do not really tell us much about what will happen in the second quarter. However, I think that given that you had this one-week general strike, which affected quite a lot of manufacturing companies in the first quarter, I think it's natural for you to see the second quarter much stronger, at least on a top-line basis. Now, on the bottom line, I think that with quite a contraction in the input costs, with the prices of soft commodities coming down over the period since September, it obviously should translate into much lower input costs and also stronger earnings for most of the consumer companies that we cover.
So which manufacturing or consumer good companies do you have your eyes on in terms of this earnings season? Which ones
at the moment
could possibly surprise to the upside?
At the moment, our preferred pick is still UACN. We still believe that it is a value and a growth play. They actually recently announced a deal which supports our view that management is a lot more aggressive than they've been in the last decade, and that they're more geared towards sustaining growth in that company, and so there are a number of initiatives at the moment to restructure core businesses, the grand cereal, which is where the animal feed business lies, the food business, which includes package, restaurant business, and some of the other peripheral packaged food businesses, and then you have the real estate business, which is quite an elephant in the mix of businesses there.
Indeed, and of course that livestock feed deal is one of the initiatives that we've taken recently.
Then let me also add that the dividend outlook for UACN is still quite robust. We anticipate somewhere an average of 7% dividend yield. Compare that to its peers yielding sub 5%. I think that those speak for themselves. And then earnings outlook strong. We're looking for about 18% growth per annum on an operating basis. And it's still trading quite cheaply at about 9.5 times the 2013 earnings. I think it compares quite favorably versus our universe of Nigerian consumer companies trading about almost 14 times.
All right, clearly you like that stock, and we'll be